Hello, this is Mark from tradingform.com and welcome to this video on a simple Renko trading strategy using Excel. In this video I will be looking at how you can calculate Renko charts using Excel and how you can then use this information as part of a trading strategy. Before I go any further, I would like to let you know that this video is the second part of a two-part video series. The previous video, how to calculate Renko charts. There is a link on the screen if you would like to watch this video and understand a bit more about Renko charts, how they're calculated and what they're useful for. Also, if you enjoy this video, please hit the like button and also remember to subscribe to this channel for lots more videos like this. This video was going to be about how to calculate Renko charts in Excel, but I've decided not to do that. And instead, what I'm going to do is make a spreadsheet that includes all the calculations, and you can download this spreadsheet for free. Just head over to tradingform.com. There is a link on the screen at the moment. Sign up there and you will receive a link with the spreadsheet calculations for Renko bars. Now in this video I've already got the Renko bars copied into it, and I will just explain briefly as well. This is actually a backtest model, a trade informed backtest model. On the left we have price data, and over here on the right, green and reddish colour, we have long and short trades. So I've taken the Renko calculations and I've put them into this testing spreadsheet. Have a click over here. We can see we've got a trading strategy, we've got the capital, we've got the market, and down here we have our Renko bars. So to go back to this for just a moment, as I've already said, you can get these calculations for free. But if you are interested in getting this whole model, which I am showing on the screen at the moment, or lots of similar models, which are a great way of testing trading strategies and refining them so they become exactly what you want and exactly what you need to trade the markets you're interested in, head over to the tradingform.com shop. There is a link on the screen and you will see all the latest models. So if you've watched the previous video, you'll know all about Renko bars and charts. If I go over here again, we already know that each one of these Renko bars is exactly the same in terms of price. That's why they all look exactly the same. The height is exactly the same. Each one of these bars is set here, so I can change this value to whatever I like it to, whatever I like to, and the bars and the trading strategy will update accordingly. Okay, so the Renko strategy, I said it was simple, that we're going to use is trading. Initially we're going to just be trading in the direction of the Renko bars. So anytime we have an uptrend, shown here by when we go from red to green, we'll go long, and whenever we have a downtrend, like here, we go from green to red, we will go short. So if I click over here, we have this strategy programmed in, and for each different bar size, we have the results here. And here we can compare the S&P 500 data going back to 2000 to the present time, early 2018. And we can see that over this time period, I've cherry picked it slightly because what we had in the early 2000s, like today, is if we've had a period of steady market increase over quite a long period. So we've got some shorts and we've got some longs, and if we're being realistic about what we can expect for the stock markets over the future, we're probably going to have to bank on them being some periods of short trades as well as longs. So over this time period, we can see here the underlying market has kind of had a compound annual growth rate of 3.7% and a maximum drawdown of something close to 57%. Now, of course, the problem with maximum drawdowns, especially ones that large, is a lot of people bail out just at the wrong time. 2008, 2009 in particular. So we've got a strategy here that has a growth rate of 4%, not really a lot different to be honest compared to the market, a slightly lower maximum drawdown. So what we need to do for a trading strategy, for in fact any market, is we want to find what sort of bar size is appropriate for that market. Now, I'm not talking about curve fitting and over optimizing it. If any trading strategy that we want to try, we're going to have to choose something that is appropriate for that market. If we're saying that these exact results are going to be produced in the future, then we are probably not going to be, that is probably not going to be the case. But still, we need to be able to get something that is appropriate, has ideally worked in the past. And if you don't know whether your strategy has worked in the past, you can be pretty certain it will not work in the future. So I've got a bar size here of 125 points. I've got a compound annual growth rate of 4.9%. So there is a few things that we can do to make this strategy better. And one of those is we can add filter. So the most basic filter of all is a moving average. And I'm going to only enter trades when the moving average is going in our favour. And if you see how I do this, I'm just going into the long trade section and I'm adding a new condition, a new logical condition. I copy them down like so. I can do exactly the same for the shorts. This time I'm going to check whether the EMA is going downwards. It really is as simple as that. You don't need a trade-informed backtest model to test this strategy. Of course, you can do it on your own, but it is a useful framework and includes things like profit targets and stop losses, which make it a bit more realistic if you plan to use those. So we can see we make a bit of a difference here by trading in the direction of the 200 moving average. Another thing we can do, we can make it long trade only. A lot of people only want to trade long, and in case of the stock market, I fully understand that. So we can try different bar sizes, different filters, and we can see how it affects our strategy. And we can see here we can get a compound annual growth rate of 4.6%, not quite as high as before, but with a lower maximum drawdown. And one of the key things I've been able to trade a trading strategy over the long term is lower drawdown. Because as soon as we start running into a sequence of losing trades, almost everybody is tempted to give up on a strategy. We need to know that the strategy we're pursuing has a reasonable level of drawdown, but at a level that we can cope with. We can increase the leverage. We can see that increasing the leverage by twice or even 3 times has a huge effect on our annual growth rate. And we can see that the maximum drawdown, although greater than before, is still a lot lower than the underlying market. We can also test the effect of a profit target. If we put that in, we can see that the strategy over time gives these results. Now, this trading strategy has been tested on the stock market, but would the same apply in a different market? And I'm going to demonstrate that it can be by using data here from the Forex market. This is the Euro USD. And all I'm going to do to show you how easy it is I'm just going to copy the data in like this. And because we've now got slightly more price data than we had before, I just need to drag it down and to find out where our bottom row was, and highlight this and double click it down. Formulas automatically update. And we need to set a bar size that is appropriate for the size of market that we're dealing with. And we can see here that because we're now dealing in pips, we can set this at 125 pips and we get something reasonable. Now, because this is a long short market, I'm going to include long and short trades. And we can now again try different levels of bar size and see what is appropriate for the market that we're testing, that we're trading. So try here 250 pips. And we can see we get something a bit more reasonable. I'm going to reduce the leverage factor back down to 1:1. And we can see we can get a strategy that over a long period of time has performed pretty well. We've got a compound annual growth rate 5% and a maximum annual drawdown of 27. And what we're looking for, as I've said before, we're not looking to have a strategy, we're not looking to over-optimize to curve fit, but we need to have something that is appropriate for the market that we're testing, that we're trading. And the only way we can do that is by testing what has happened in the past. We see here, one way of thinking about it, and I like this explanation, is we're looking for a sweet spot. We're looking for an area that is showing pretty consistent results. So if 205 gives fabulous results and 206 give terrible results, we need to discard both of them as not much use for future, as a guide to future performance. So once we've found an area that's stable, we can then look to see, well, what is the effect of different types of targets. We can try stop loss. And we can see how that affects the results. See, we get a lower drawdown. Once again, we can say, well, if we're happy with the strategy, let's have a look what greater leverage would do. And you see, unsurprisingly, we're getting a greater compound annual growth rate at the expense of a greater amount of drawdown. We can change the size of our EMA filter. And we can control all of this through clicks on here. So there we have two different markets, both using a Renko chart trading system, got different options, targets, and different amounts of leverage. Don't forget, if you like to use Renko charts in Excel, you can download the calculations absolutely for free. Just go over to tradingform.com and subscribe there. If you want this exact spreadsheet, go over to the tradingform.com shop and you will find it in there. And if you would like more information about trading the financial markets, please go to www.tradingform.com.